Testing, one, two, three. Testing, one, two, three. Yes, testing. All right, let's see what's going on here. Testing, one, two, three. Looks like we might be actually live. Hello. Hey, hello, welcome to the live stream. So this is March 30th. I just wanted to do a little live stream here, just a stock market update, because I was just basically checking on what's going on in the morning. So yeah, so let's look at what's happening. So I guess the sort of the big thing right now is that the yields are ticking up a little bit here. They're up 2%. It's worth noting here that the yields are at the highs of this recent run, and then if we go to the the full this here, yeah, they're at the highs of the recent run, so they're pretty much almost at like 52-week highs, right? So you go back a year, it's like they're breaking out to all-time highs on the yields. So let's see. So this seems to be causing a little bit of pressure on the tech stocks, but not much. It's not like wholesale sell-off. Yeah, there's some selling pressure there on the Nasdaq right now, and then if we look at the S&P, they're actually kind of performing similar right now. They're both selling off a little bit. But the big thing that's going on, what's the dollar doing too? Well, the dollar, look at the dollar. Gee willikers, this so far, I mean, it's only at 0.2%, but it's kind of a strong bar. So it's kind of, the dollar seems to be moving up a little bit here. Yeah, so that's interesting too. So I guess one of the things that's going on is that oil is down a little bit, and then I just want to look at the XLP. Is this one holding up? Yeah, down a little bit today. Interesting. So they finally got the XLP today. But the big thing today that's going on is that, we had this Archipelagos, hedge fund blow up. And what happened is that they literally, basically went bankrupt. And they basically had a bunch of margin. And the banks that had lent them the money basically are now taking losses. So you have all these different big financial institutions, and the numbers are something like $6 billion of losses they expect. So this is really large losses. I mean, in the scheme of things, it's not large. But this is exactly what happens when you're on margin, and exactly what happens, when you're on margin. When you're on margin, there's a certain ratio that you need to have. So if you're sitting there and you're buying a bunch of Tesla at $880 a share or whatever, and that thing drops to 600, okay, that's fine. It just depends how much margin you have in your account. But at some point, when if that value goes down, you're going to be asked to add money to your account. If you don't add the money to the account, then they're going to be forced to liquidate. So basically, what it appears that has happened, and this has happened before. This happens not all the time, but it does happen. This happened in the financial crisis a lot. Like, when you look at what happened in the housing crisis, the 0809, the what they call the Great Financial Crisis, which really it's GFC, which what we're going through now is much worse than that. I know people don't want to believe it, but it is much worse than that, or it will become apparent. But the point is, like early on in that, two hedge funds went belly up, and the same kind of thing happened. What happens is the hedge funds are on margin. They have been buying stocks at really high prices, and as soon as the price of those stocks come off, they are required, they got to put up margin. And this is exactly why the broker company is like, I need you to put up margin. Why? Because in this particular Archipelagos case, they weren't quick enough to ask for margin. They weren't quick enough to force them to liquidate the positions. For example, if and this is actually a good thing. Like if you had a company that comes in, and let's look at it as aggregates. Let's say they have a bunch of positions and they're buying, and they're like, oh, this is a great buying opportunity here, this dip. And they're doing this kind of thing all over the place, and they're in, all these high beta stocks, and all these high beta stocks take a hit, and they're down like 20%. Okay, well, here, if they had levered up to the point where it's like, so I'm looking in aggregate. They could be spread across 50 stocks, but they're all the same type of stuff that all take the same kind of hit. As I've talked about on this channel before, how they're all, there's a whole bunch of stocks, they're all trading together with this particular pattern here. So you may have 20 stocks and think you're diversified, but you're really not. Even if they're different industries, different whatever, they're all trading the same, so they're all correlated, so you're not diversified. If you have 20 of these stocks that all have the same pattern, you're not diversified, okay? It's the way they're trading. It's the beta in the stocks. It's how they're trading, so they're not diversified. And so that's a good point to understand is like, you think you're diversified by market cap, by industry sector, by industry group, by, all these different things, market cap, blah, blah, blah. And the reality is you may not be, and it may change. And that's the other thing. It may change. Stocks, for whatever reason, you could have the cigarette stocks correlate with like really crappy tech cannabis stocks or something, and they start getting correlated, and all of a sudden your diversification isn't there. I mean, that's pretty rare, those two grouped together, but you kind of get my point. You have to kind of keep an eye that it does kind of change. So the point is, if you're up here and you're buying all these stocks, and of course they wouldn't buy all Tesla, but they're buying, if for example they were like looking at this situation, and let's say these hedge fund guys are like a Meet Kevin, and they're just like, oh, this is an opportunity. Oh, this is an opportunity to keep buy, and it keeps going down on them. And let's say they're doing this across their portfolio, and the portfolio goes down 20%, and then it goes down, and they've accumulated a bunch, and now they have a bunch of high prices, and they accumulated on margin, and oops, it goes down another 10 to 15%. Oops, what happens? They're going to get margin calls. What if they don't have the money, right? They don't have the money. So what's going to happen? They're forced liquidation. And this really is the key thing that, once again, the Meet Kevins of the world don't seem to understand. They're in denial about this. Like, all these stocks, you can look at these stocks, well, I want to buy growth. We want to buy growth, things that are going to grow. I get it. But the problem is, if the people that are holding those stocks are paper hands, I mean, paper hands is good. Diamond hands is the problem. These guys think they're diamond hands. The Kathy Woods of the world think they're diamond hands. Oh, they're strong positions, whatever, until they're overextended. And then they have no choice. There's no strong conviction anymore. It's like, what choice do you have? You have no choice. You have to liquidate the positions. And then in this case, with this Arcos, whatever this name of this thing is, they actually caused the banks that loaned them money to get $6 billion in losses. And it happened. Now, I don't know how quick it happened, but it happened relatively quick. So this is what you have to remember out there. When you're out there and you look, we have pretty high margin debt. And you can go look at the FINRA has a chart on that of the margin debt. And you can kind of look at it. And yeah, they got some pretty high margin debt out there right now. Let me see if I can find that chart. Just a second. I had put this together, but I actually didn't totally prepare it for this. I was working on my other clock project. But yeah, so this is showing, and this is the most recent, this is on FINRA, and this is debit balances. See, credit debits, I forget, but debit balance is the one where they've, I believe, check for yourself, but that's the one where they've actually like used the credit. So for example, if I'm Ameritrade or some big financial whatever, and I extend you, hey, I'm extending you credit. I'm letting you know that you have $100 million worth of credit that you can use, of margin available, margin available to buy stocks, which is credit, right? But if you're not using it, it's just a balance here. But when you use it, it becomes a debit. When you actually start going and buying stocks with it. So what you see, since March low, we've had this big run up in margin debt from 500,000 to 800,000, which I'm not sure. I don't see what the numbers, they're not telling me what the numbers are. I assume it's either millions, so it's like 800 million to 500 million, or it could be 800 billion. I'm not 100% sure, but just look at it, you can see this. Now, I don't know, I mean, I haven't gone all the way back. This may not be an historic high. It may have been higher at other times, but you need to understand, if you're out there and you're out here in this period of time now, and you're buying dips out here, think about it. The market, all the moves from this market, a big chunk of these moves are due to this margin debt. People borrowing money to buy stocks. They're borrowing money to buy stocks, so they're in a risky position. they're in a position where if they overextend themselves, they are going to be forced to sell. And your reliance and your strong conviction on your stocks is reliant on banks and financial institutions to continue to extend credit. So when you see that, it's like very clear that it's like, okay, I mean, this could be fine. This could go on for years like this and it going up and up and up. But the problem is it's risk. Its problem is when you have any kind of correction for any kind of reason, this kind of thing can happen. And you'll get forced selling. And it doesn't matter. Once again, it's like, who cares what Tesla's outlook is? We don't care. We have to sell. So the other thing I wanted to comment on too is you'll see weird stuff. When you get to liquidations, remember these funds may be long and short. So therefore, so here like ARK is selling off, CCIV up a little bit today. But what you can see is interesting things. You can see where you have them forced to sell. So let's take today Arcimoto. Is this part of this? I don't know. Don't have any idea. But of course you won't know till a couple days from now when they report, oh, by the way, so-and-so blew up and they hit a bunch of Arcimoto and they sold it, right? You won't know, right? But so for example, let's say, oh, this is down 7% today. Wow. And note, this is broke through the lows over here. So that's this full-on bearish. There's nothing, there's no buying a dip there. This is no dip. There's no dip. You dip into a moving average and come off it. That's a dip. This is a short-term downtrend. But like if we compare that selling off to like GME, and GME's up a little bit. But like if I like the big picture chart, you take Arcimoto, these other guys, they've all just gotten the crap kicked out of them, right? Sell off, little try to recovery, fail at the 50. That's what you see a lot of these charts of these high beta guys, EV plays, fail at the 50 and go down. But one of the ones that's been like, holding up really well during this time has been GME here. Not back here, but in this period of time up here in March, it's been holding together. So what you can see, and I don't know, but you just have to, because you can't know. You can try to like figure it out after the fact, but you got to understand, like when there's liquidations going on, yeah, generally that's selling of stock, but also it's buying, because of the same thing. If that company, that hedge fund that's going bust, they have to, like a lot of them will have to have some kind of a long short, and they should be 50-50, but they may not be 50-50. So the point is, you can see stocks being bid up, other stocks going to like seller pressure, and other stocks randomly coming up. Here's XBEV has got some buying pressure. Well, why? Because they're short some positions, and they have to close the shorts too. Even if they're profitable, it doesn't matter. They have to go buy that thing. So this, I remember this very well, and there's funny, even on CNBC, they were commenting about it, like in the tech crash of 2000, I think it was, you would see like the tech sector, every stock was down 5-6%, and there'd be like one like SanDisk is suddenly up 10%, or was Rambus or something was up 10-15%. They're like, wow, this is really odd. We don't know what's going on. And the reason for that is that it's not like, oh, people have conviction in this stock. No, it's just like they just happened to have shorted that stock. So here they are, they're liquidating because they're getting margin calls. So they got to sell all their longs, but they also have to cover all their shorts. So they got to run out and do that. So the point is, this is where I've been trying to highlight in some of my videos about, like, get rid of this concept of this strong conviction nonsense. Your strong conviction, it has just been fueled by margin debt, people borrowing to buy stocks, and that's only like so sustainable. And remember this, when you're borrowing, you have a little bit of a negative carry here too. Like, I don't know because I don't do margin, but like, look, they're not lending you money. Are they going to really lend you money at like 1% or 0.5%? I don't know. I'm betting more 5, 10. If they don't like you, they're probably charging you 20%. It's like a credit card payment to borrow money. So you're out there. So what's been happening this whole time? So okay, so this March 1st, you have people piling into stocks, and when they do this, it's like, okay, they're charging you for it. You got a negative carry. This stock needs to be going up enough to cover your negative carry of the margin that you're paying, the interest you're paying. So if you're paying 10% on that money, or even 5%, the dang stock better be going up more than 5%. And if it's not, even if it's flattening out and going 2%, then it's costing a lot of money. You're getting eaten up. So those are the things that are going on, and I think I just have my general theme about this nonsense about strong conviction. Um, Technicals always override fundamentals, and they override it once again because of this. People are buying stuff because of the fundamentals, but it just gets out of hand, and then they're forced to on the technicals. They're forced to just liquidate. And even the Meet Kevin guy, even that guy is he's like, well, if I get in the margin trouble, the first thing he was stating in one of his videos, he's going to sell the Bitcoin first, right? So okay, people have strong conviction in Bitcoin. Bitcoin's a great asymmetrical whatever, but for that he's like, I'm gonna unload that. Now, what's to say that some other hedge fund guy's like, well, the first thing I'm liquidating is Neo. Oh, the first thing I'm liquidating is Tesla, right? And so now, if you put this all together and you say, well, if we have one hedge fund blow up, why isn't there? What's to say there isn't 10 other hedge funds? This is a very simple thing. Well, how many other people were doing the same stupid thing or is doing the same thing? And given the margin debt chart that we have, we getting overextended. There could be 100 or 1,000 hedge funds constituting trillions of dollars that are overextended. So this is how things get out of control, And so that's why it's kind of like the technical side is, from my opinion and my perspective is, you got to pay attention to the technicals because if you don't, you get yourself in a sticky wicket. And I don't know where I picked that statement up. I think it's I want to curse a lot, and so I just put sticky wicket in there. I know that's something from either kind of British, right? Either British or something. I don't know. Someone can correct me. But yeah, I just use it instead of start using the F-bomb. So yeah, so that's what's going on today. I think though in the big picture, there's not, this is not like wholesale. There's a little bit of selling, but this is all kind of controlled stuff. I mean, look, I'm looking at this saying, well, it's not a big deal. It's not as out of control selling day. It's just a day that things are down a bit, and that's all there is to that. Now, what I want to do is let me just put the 3-month chart, and let me just save this one. Come on. Save as, and I just want to put a note on this. 3 months. Okay. Yeah, it's kind of interesting. They get to my staples though, consumer staples. See, the problem is this is way overrun. It's way overbought in the short term. So this consumer staples is going to have to correct. Now it's kind of interesting because if this thing, the consumer staples, see, it's almost it appears from what I'm seeing is there's a rotation, right? You rotate. They've been rotating into the consumer staples from the NASDAQ. So if I go here. Should be able to do this. Dang it. Price. And we go dollar. We'll just do it that way. And we're going to just look at this dash thick and pick a color that will stand out, I hope. Let's pick out red. And okay, so we can see that the SPY is, oh, that's not what I want to do. I have a better chart for that. Compare to S&P 500. So if I take my, yeah, so now I'm taking my XLP and comparing it. So you can see the green line XLP is kind of ramped up to straight. Now, it's interesting, they both kind of have made it to the same point. They've really made it to the same point. But it's just that the XLP has been more stable in this correction. Like when the SPY kind of pulled back here in March 17th to 25th, XLP didn't. It continued to go up. But it's worth noting that they're both really at the same place. So although XLP is kind of stronger performance through that small period of time, let's go back a little further. Yeah. So they are really kind of at a similar type of move performance-wise. So, but there's maybe a little less beta. I don't know. I don't know. It's hard to say. It's hard to say. But it seems like XLP to the S&P. So what I really want to do is I want to compare this to the NASDAQ. Is it going to do what I want it to do? XLP to the NASDAQ. Okay, no data. Okay. Let's do this. So it's saying no data. Okay. Let me do this. So let's see. So okay. So now we have the XLP. So it's a green line, and then you see the Nasdaq. So if you kind of look back and you see the Nasdaq is selling off, and it's kind of overdone. It goes down here and then goes like that. So it's kind of selling off, and then so it just most recently there's kind of more of a move. You're kind of seeing a rotation, because the thing is, a lot of the big funds, they may not really be able to go all into cash. So if they're like overextended on the NASDAQ type stuff, then they may go into consumer staples or something like that. They'll just have to go ahead and do that because they can't just go into all cash possibly. So that's why maybe that would happen. They're trying to park some cash. So I think that's it for this one. So we'll see what happens. I'm not... this is kind of interesting. The yields went up, but they kind of haven't really broken out. They're just kind of really hanging at that high. So I think that's what's going on for today. And interesting oil. I wonder is oil going to be a buy here? I don't know. The problem with oil, the problem with oil is, see, because we can see that oil's in an uptrend, right? So we can see that it's an uptrend, but kind of the thing is, so is the dollar. So that's one that I'm not clear on, because I guess that's the question: is does dollar and the oil go up together for periods of time? Because that's what it seems like it wants to do right now. Let's see. Yeah, so here's your dollar, and then if we put oil over here, gosh, there's got to be a better way to do this. Let's see, USO behind, and we want to maybe make it green, make it really dash thick. Okay, let's see what we got here. We got the dollar and oil. Did I put oil there? Yeah, I did. I've got all these different lines here that are probably just confusing me. Okay. So I have the dollar. The dollar, we see the dollar's kind of bottomed and picking up, and then I wanted to plot it versus oil. Behind, I want it behind price. I see, so it went somewhere else. That's not helping me. Yeah, so this dotted line is the oil. So yeah, so right now, you can see that here at this period of time you have oil going up, dollar going down, kind of that divergence. See how they're going away from each other, but now they're it's, the oil's kind of correcting, but it's still kind of in an uptrend, sort of. So like if I annotated, let's see, maybe we'll try that. So I'm just trying to figure this out for myself, and so just watching. So you can see kind of here's the oil in this green dotted line. It's kind of going up. Okay. And it's interesting. So during that time, you see that the dollar was going down for a period of it up until about this point. Then the dollar flattened, and now the dollar is kind of going up. And what's interesting is the dollar seems to be going up with oil, but you can see here that there's kind of the question over here is going to be like, definitely oil's taking a little bit of a hit. Is it going to continue to go up and go up in this trend, and is the dollar going to continue to go up? Your dollar here is kind of working its way into resistance here. Auto support resistance, let's try that guy. So Yeah, your dollar's about there. So, your dollar's working its way into this resistance here. And, yeah, interesting. So I don't know. So it's possible that that's something that I'll go look on a longer term chart and try to see if there's periods where the dollar rises with oil. Because see, the problem is normally like you're like if your dollar's rising, that would put pressure on commodities like gold, but also like oil because oil is sort of denominated in dollars. So if the value of the dollar is going up, then normally it should be, less dollars to buy a barrel of oil because the value of the dollars using to buy it should go up. So that's sort of normally the thought behind that. So I think that's it for this one this morning. So talk to you guys later. Bye.